Howdy, Jacob here. Today we're going to do a deeper dive on Endava. Their initial analysis is pretty much right where the price is today. And so I read through the most recent quarterly reports and 20F that came out in the last couple months. And I just want to remind everybody about the business. So I'm just going to go through a little bit high level of the numbers, and then I'm going to go over some of the pointers that I took from the quarterly reports and 20F. Keep in mind that everything I say is my opinion. It's what I took from the reports. It's not meant to be an end all be all. Do what you want with it. But don't invest because if it looks like a great deal, don't invest just because I think it's a good deal. Do your own analysis. Just be smart with it. So we have an IT services industry, 1.5 billion market cap on 1.6 billion enterprise value. They're in the technology service. They provide technology services for clients in the consumer products, healthcare, mobility, and retail verticals internationally. Founded in 2000, headquartered in London. Humongous revenue growth, but we do see a spurt or a hint, a little chip in the armor the most recent year that dampened both revenue as well as margins. And obviously, that's going to impact your return on invested capital since your non operating performance, the NOPAT, the numerator of that ROIC, is dampened. And from a balance sheet perspective, good amount of cash compared to their debt. So they do have a little bit more debt than cash, but in relation to their free cash flow, it's not significant. Majority of that free cash flow going towards acquisitions. So let's look over some of the pointers that I took from the business from reading through the quarterly reports in 10 and 20F. So they specify free cash flow in the quarterly report, which I appreciate. Some companies point out cash from operations. Some don't care about the cash flow statement at all. They only care about not even net income, but they care about EBITDA, which is something I could care much less about. And the other metrics pointed out that are important to management appear to be cash on hand, headcount, and number of clients. I appreciate the honesty of the CEO. As I stated before, their revenue was down year over year, and so he was very honest about it, saying that demand was low. But I would really like to see. Them be not necessarily not more honest, but I'd like to see them be specific with how to turn it around. And so when you have revenue that's dampening yourself and your company, specify ways that you're going to get out of it. He's kind of just saying, we'll find a way. We've done what it takes to really put ourselves out there. And I mean, obviously, that's not verbatim what he's saying. This is just me going through, remembering it in my head. But in essence, he was just saying, we've done what it takes. We've gone through the bad parts. Now we're going to get to the good parts, and it's going to slingshot us forward. But what is specifically going to make you slingshot forward to go back to possibly the demand and the revenue growth that you were seeing last year or 2 years and prior when it was 20% year over year growth? I mean, look at this growth from 2016 to 2023. Their lowest year over year revenue growth was 20.4%. So I want them to be more specific with it. But again, I do appreciate a CEO that's honest and is not just trying to fake it. I've read a lot of quarterly reports where they're like, everything's rose and butterflies. And I see, revenue down or margins down. The things that I care about are down, and everything's fine to them. So I do appreciate it, but I want more specifics. There were 3 verticals make up a significant portion of their revenue. So 24% to payments, 15% banking and capital markets, 23% to tech, media, and telecom. 91% of revenue was from existing client base from last year. Their 10 largest clients account for 32.5% of revenue, down consecutively over the last 3 years. Consecutively over the last 3 years, their top clients represent less than 10% of revenue. And so good that They're able to keep their clients from last year. Very positive. Top 10 clients making up 32.5% of revenue, with your top client less than 10%. Means you're not super concentrated on one specific client. That's always good. Geographically, 33.4% from the UK, 32% from North America, 25% from the rest of Europe, 8.1% rest of world. So this isn't necessarily a bad thing, good thing. This is just stating that this type of business does not have many barriers to entry. So there's going to be a lot of competition, and your client may just use generative AI instead of having you help them out with it. Again, I don't think this is as bad as if you read this, you're like, oh, they just use it themselves. Why would they pay somebody? But just having that third party assistance, you don't have to hire somebody. It's usually actually less um, costly, because you can focus on what you're focusing on. They can focus on helping you, because they don't usually just have you as the client. They have multiple clients. And so it's usually not very expensive to do so. But I just wanted to call that out and say, it is a very competitive marketplace. Good relation with clients, they've stated, but no long-term commitments to where you can terminate within 30 days. Again, it's not with 91% of people keeping revenue. I think that we're fine with that, but that is a possible risk. That is something to keep in mind. No intention to pay a dividend in the foreseeable future, but they plan on selectively pursuing future acquisitions. As we've seen from their cash flow statement, a lot of their free cash flow is going towards acquisitions, almost all of it. A little bit was going to debt reduction, but then they issued a lot of debt for a large acquisition here. They're led by their founder and CEO, who's currently 63 years old. He's the oldest person of all the executive officers. He owns 15% of shares outstanding and has 45% voting power. I like when management has a lot of ownership in the business, especially a founder and CEO. That makes sense that they own a lot of the business, and me owning the business is going to be more confident of them doing the right decisions, as they themselves are heavily invested in the business, which they are 45% invested in the company. That's positive if I'm investing in them, because they're likely going to do its best, as they themselves are heavily invested. Small but consecutive increasing of employees. That's always good. From a world standpoint, it could, sometimes you don't want to hire ridiculous employees that aren't doing anything. They're not helping the bottom line at all. But again, this is a positive sign. Again, like I stated before, it's one of the numbers that they like to count out is headcount. Of their 695 clients, 33 have revenues greater than 5 million, 48 between 2 and 5 million, 65 between 1 and 2 million, and 549 below a million. They have 50% of their assets as goodwill. Again, a lot of acquisitions here. It's not really surprising to me. Free cash flow the last 3 years entirely going to acquisitions. So much so that actually over 100% was to acquisitions, since they issued more debt than they repurchased. 144 million of debt due in 2027 in relation to their free cash flow. That is less than 2 years. So we're definitely not concerned with that debt figure. So my new assumptions based on the revenue decline currently, I'm dampening their revenue growth. I do think there's still a lot of growth ahead of them. But with that said, I'm increasing my margin of safety from 15 to 17 and a half. And that's one, because it's advisory shares. So they're, not necessarily the advisory shares, but a lot of their revenue doesn't come from America, over 70%. And so is that correct? So yeah, so about 67.4% comes from outside North America. So there's a lot of things that I don't know outside of it. I want an extra margin of safety. And then I just barely dampen the margins, and then dampen the terminal P and price to free cash flow due to less growth, prospectively. So now we're saying 39% drop before we get the return we're looking for here. Again, not terribly far off. I think this is an interesting business. So I hope you do your own analysis, make your own assumptions, have fun with it. And yeah, I hope, it's something that maybe you didn't see before that could be a possible investment for you in the future. Hope you enjoy the video. Have a great rest of your day.